That we've got some really good intellectual discussion. This morning I am delighted to be joined in this fireside chat by the Hans Gorgeson, who is the CEO of Royal London Asset Management. So we have, if you like, voice from the den of iniquity as the asset manager from after what we've just heard. Now, we spend a lot of time preparing for these things, but actually I think we've heard so many interesting comments in the last couple of sessions that we might go off topic a bit. But just to put some context around this is a session which is promoting this wonderful publication, and I'm delighted to be the first person to hold a hard copy. It is hot off the press. Angus has just given it to me. This is the publication that we are talking about. There will be QR codes, I believe, outside that people can download it. But if you'd like a hard copy, I believe you are able to purchase one. Is that right, Angus, Omar? And this is the publication which celebrates Smith's 250 anniversary of his Wealth of Nations. And it's a fantastic read, having been able to read it before it was published. And this is thanks to your lovely firm for helping sponsor this. So this session, for the next 20 minutes, we're looking at theory to practice and the role investors have in shaping the markets. Now, Royal London has been part of this conversation for many years. In 2021, they partnered on the Wealth of Nations in the 21st century, which explored what Adam Smith might make of economic and social challenges shaping the world today. Now we've got this 250 anniversary, the new collection, Reframing Wealth, revisits and reimagines the work once again. But I think one of the questions I would like to start with today is slightly controversial. Are you here for profit or purpose as an asset manager?
Thank you, Amanda. It's a delight to be here, and I think picking up Sir John Kay's comments, down south they would have said football's coming home. I think here the higher bar is the intellectual quality of debate is coming home. I think 250 years on, it's remarkable to see. So I will see over the next 20 minutes how many bear traps I can put my feet in.
Yes, that's what we like to hear.
I'm an economist, so I'm already daunted slightly. I cut my teeth in American investment banking environment, so interesting. I'm an asset manager, and we own, I think, about a third of the London sewage system, so we may well come back to that one.
You were asking who owned it.
So in an august environment, I'm a mere profit hunter, I would say. And I think the curious thing is how you come to be a profit hunter with a pretty sharp focus on returns, working for a mutual that has a real purpose that stands behind it. And so what we do is we run about 130 billion of assets on behalf of policyholders. And I think that our policyholders, I have an extraordinary position in that everything I do goes back to our policyholders. So you either get an investment return because we've delivered something for you, or you get the profits that we generate, or you get the enterprise value of the business that we run. So anything that I do ultimately goes back to the policyholder. But this is not a charity. Everything that I do is commercially driven. And I do think it's really interesting when you go back to some of the sort of economic principles, which is Adam Smith was very much a open market, free marketeer with constraints. And I do very strongly believe in free markets, but you have to have a framework around it. And we may well come on to stewardship and talk about it, but I'll pause there and hand over to you.
Well, so I do think it's a really interesting debate, and I love some of the things that Sir John was talking about, who actually owns these companies. And you've talked a little bit about this mutual benefit that you have. What's your view, given Sir John's comments, on who actually owns the companies? Because I do think it's a fascinating one.
Well, I think it cuts to stewardship, actually, and I think of stewardship probably in three levels. So the first is at the policy level, the second is at the sort of company and corporate level, and then the third one is at the sort of direct interface. So one of the things that's probably less well known is that as a mutual, probably as the largest mutual in the UK, we do an enormous amount of work behind the scenes with government, with ministers, trade bodies, to try and influence debate in the right way. And in the right way is with a social purpose, with an environmental purpose, and actually explicitly with a focus on the UK. So Mansion House Accord, as an example, is very much focused on the UK. We were one of the very early signatories to that. We're already ahead of what we need to do, but we're not doing it because the government is putting pressure on it. We're doing it because we think it's the right thing to do. So I sit on a board, an investment association board, which is unusual in the interaction it has between Treasury, ministers, regulators, and industry. And it's probably the only country where I've seen that level of integration really drive, or try to drive improvements for UK PLC. If you then think about the second area, which is corporate level, we do a lot of activity. So you have a lot of activity in terms of engagement. We do 50,000 votes a year. We've engaged with about 500 companies, 5,000 meetings. So all the metrics are there. But ultimately, it comes down to individuals. And a lot of people at boards are ego-driven. And so, oddly enough, when you go in as a company and vote against an individual or vote against a position or a policy, it's the individuals on those boards that feel it. If you really want to have an impact at some of these companies, you talk to the head of Remco, who determines the pay of the individuals. And I promise you, I see this on the inside as well as on the outside, the level of sensitivity and reaction that you get is disproportionate to the amount of effort that you put in terms of that engagement. So again, we may come back to that one. The third one is what I call direct influence. And so we do this in two ways, two examples. One is the farm. So we own a farm in the UK, slightly smaller than the Isle of Wight. It's 64,000 acres. And we do this, just to be clear, for a commercial return. We expect to make in the order of about 10% return a year, but we will take a 30, 60, 100-year view on this. So in really simple terms, we'll make about a 1% return on a running yield basis. So 1%, you can go out to the bank and get 4 or 5% today. The second area is the capital appreciation, and you have to take a really long-term view. So it may well be 30, 60 years before you get that capital appreciation. The third area starts getting a bit more fruity. So it is in Norfolk, Cambridgeshire, Lincolnshire. A large part of it is peatland. You can flood the peatland, and in return, what you get is a carbon soak and a carbon credit. So you can then start either trading those carbon credits, or in our case, we offset it with the buildings that we put up elsewhere. And then you go to the next stage, which is we also have an infrastructure company, which is Dalmore Investments. But the interesting bit is the space above the flooded peatland, we can rent out to a firm, or we can do it ourselves and put solar panels over the top. So in each case, you're adding 1 to 2% return. Alongside this, because it's just the way that we think about it, we are looking after 800 miles of waterways, 1,300 miles of hedgerows, which we planted. The bird sanctuary next door to us is wildly excited because the space between the solar panels and peat is exactly what they want to focus on for wildlife. So I suppose what I'm trying to get across is that we run this on a commercial basis, but you can run things on a long-term commercial basis in a way that is good for the individuals, good for the firm, and ultimately good for either the environment or the economy.
The different types of stewardship, because obviously if you own land, that's going to be quite different from owning a company.
Thank you. So I think it's relatively straightforward. So listed companies, you vote, and it's quite a mechanical process, but you are able to influence the votes through that in, as I said, a fairly disproportionate way. Debt holders, it's more of a dialogue that you have in terms of what our interests are. We're very clear in terms of the requirements that we put in. And then you get into the private assets and the sort of infrastructure investments that we've talked about. So in addition to the farm, we were talking about the sewage company earlier. So this is Thames Sideways. So two different angles, both water related. The first is the London Super Sewer, so 25-mile concrete circle going around London. That is a really clear example of where we have put environmental, social criteria in terms of what we expect. And we, to an extent, we represent the owners of about a third of Thames Tideway. The related one is one called Corey, which runs the barges going up and down the Thames. Is a very, very successful financial enterprise for us, but is principally focused on transport and cleaning the Thames River. So again, what we're trying to do is get a long-term perspective, and we can do that because of the mutual background that we have. Get a financial return, but do it in the right way.
Now, I am going to open it up in a second for questions, so think about if you've got any questions here for Hans. But I've probably got one last question from my side before I open it up, and that's a sort of almost like a follow-up on what you were just saying. So Adam Smith wrote, "In a world where natural resources felt limitless." We've also heard about the failure of governance structures and corporate structures to actually hold companies to account, like Thames Water. What you're talking about sounds lovely and rosy, and you've got the mandate, you've got the ability to drive that change, you've got the ability to do it in a responsible fashion. But from where I'm sitting, 30 years in responsible investment, I feel slightly worried we're going back into greed is good and it's all about money, money, money. What do you think, if you had an ask in terms of, in an Adam Smith context, what do we need to do to make responsible investment in stewardship work outside of your rosy bubble, if you like?
Well, I think the Thames Water one is a really interesting one because, in a sense, I think that if you break each component down, each component was probably operating the way that it thought it was incentivized. So the individuals, whether they were private equity or elsewhere, were motivated to drive a return. The boards at the time, and I completely accept your point, were probably operating within a framework where they thought they were doing what was acceptable in that framework. There is no doubt that there has been a failure along the way, and so the hard bit is how you get the framework and the governance right. And I think it goes back exactly to Adam Smith, which is untrammeled, competitive markets are, in my view, unlikely to be morally guided without a bit of support and guidance along the way. So you have to have that infrastructure around it. The question is just, how do you get the infrastructure to work in the optimal way? But I do agree that it hasn't worked over the last couple of decades.
Do we have any questions? We've got one at the back. Is there a microphone? There's a microphone coming. Here we go.
Thank you. Celia Waring from CCLA. At the launch of the recent papal encyclical, the Pope wrote about what it is to be human in this age of AI. And Chris Ola stood up and said, us tech companies can't govern ourselves because the competitiveness, the incentives, the commercial pressures are just too great. So a complete sort of absolution of responsibility. Is it naive in this day and age to push that responsibility back on them, which I think we should, or do we just have to accept that actually competitiveness is just how it is, and therefore the structures and maybe to Professor John Kay's point, the systems of control that sit maybe around these companies need to be more robust, or is it some combination of the two?
Question.
So I think that's a really great question and topic. So I think you've got probably the areas that you'll know very well about, the ethical, environmental concerns around AI. I think the one that is probably most pressing at the minute is the likelihood of self-governance of AI, I think, is low. And I think it's low because of geopolitics more than anything else, which is if you think of where China is and think of the geopolitical agenda that China has relative to the US, I think any level of self-control in the US is unlikely to be observed by China. And so you simply put yourself as a competitive disadvantage. I can't see why either the US government or individual firms, and I think Anthropic's position was really, really interesting in terms of the way that they were willing to confront the US government. But even that level of self-control is unlikely to succeed in the short to medium term, I would say. So it's slightly extreme, but you almost get to a sort of nuclear superpower state where you need to have a balance of those powers as opposed to self-control.
Another question, we've got one down here. Just behind you, there's a microphone.
Thanks very much, Liz Grant from University of Edinburgh. And we've talked earlier about changing the game, changing the rules, changing even the players, but do you think we need to change what winning means? In one sense, you've almost indicated that. But if we are to change what winning means, what would the narrative be? What's the single most important thing you could say to a company that's not interested in environment, not interested in anything, interested in profit but alone? What would you say winning should mean?
So I think governments and probably economists have battled with this for decades, if not hundreds of years, in terms of what you're really asking is how do you price in externalities, and it continues to be something that really challenges people. I am a strong believer in that from a competitive and a commercial perspective, individual players, and I do think that Royal London in that regard is unusual because of the construct that we have, but certainly in a shareholder-driven environment, the likelihood is that the commercial drive will continue to be the primary drive until you can find a way either to control it or to price the other externalities in, which is really tough.
Right, I'm going to wind up with one last question for you because our time is coming to an end. I'm so sorry, I don't want to overrun. Sarah will not be very happy with me. So I'm going to use my power as the host of this to ask you, what do you think the solution is? Is it a case that all asset managers should become mutuals? There's one question. If you had one change that you could make today, and you had the power to do it, what would it be?
I think if you could change it to mutual, I would, actually. And I think that if you go back in history, and interestingly, if you go to Europe, Australia, the US, the mutual sector is much stronger and much more vibrant. And I think particularly for the economic environment that we're in today, it is a model whose time has come. And I don't say that because we sit in a mutual, I say it because the alignment behind the underlying policyholder, the individual, the man or woman on the street who we are investing on behalf of, through to the investment returns that we're trying to generate, through to what we're trying to do from a government, economic, and national infrastructure perspective, is a very, very powerful one. And it is one that we have progressively, I think, undervalued in the UK.
You heard it here, mutual, the time is right. And actually that brings us right back to Adam Smith's Prosperity for Society. Thank you so much, Adam.
Pleasure. Thank you.